Okay, let's get started on looking this past week and into next week. My opening comment would be, you know, it things are pretty um, bleak at the moment. Would probably be a good word to use, and it doesn't take much. We go to the fear and greed index that CNN puts out, and we're on the cusp again of extreme fear. And, we kind of had a little bit of a recovery looking at this chart. And now we're on our way back down. And today, Friday, well, this whole week has just been really ugly for the markets. And, you speak in terms of, people who are uh, that are not trading, they're just investing. And um, you know, they only have one way that they win, and that is if the markets go up, because typically a lot of investment advisors, they don't give you the option of puts and calls and, doing more sophisticated things as far as investments go, because, the stock market always goes up, except when it doesn't. So, that's the fear and greed index. I think it's pretty representative of what happened this week and the fact that we're on our way back down. Uh, you know, everybody's, but when everybody gets on one side of the boat, the tendency is that you're going to see a snapback here. Uh, how big it is, how long it is, I don't know. But that would be the expectation, at least in the short midterm. Um, so let's take a look at some of the numbers. Let's start with the 10-year Treasury. And, you know, I've been expecting this thing. It's been on a pretty good long run up, dating back to April this year. And, we got out, or maybe even May, but, it's just been a grind up as far as the 10-year yield, and to keep waiting for this thing to roll over. I thought it might, because this was a point in the past. Let's just look at the weekly. Might be able to see there's some resistance up in this area, and then the next one's up around just under 5.3% for the 10-year. But this is playing in. This is crushing. Um, you know, mortgage rates. I mean, as far as well, I should say it's crushing home building and selling and things of that sort, because the 30-year mortgage is goes up as the 10-year goes up, and so we have a situation that's just untenable. And we'll see what happens moving forward. But if this thing doesn't continues on up and it does hit 5.3%, there's going to be some wheels falling off some things. Whether it's banks or whatever. They're already. I read an article about Bank of America. That they showed 22 billion in profit, but they have 45 billion in liabilities on loans. So it doesn't look very good. Um, Especially as this thing continues up, we'll take a look. We look at the economic calendar about where mortgage rates stand today, but they're not going down. So that's an economic driver. Dow Jones Industrial continue to crush down just like everything else. This is a weekly chart. We got the head and shoulders. We never got the benefit really of it. You're usually looking at something around what from here to here was 9%, and once we broke the neckline here on this inverse head and shoulders, we go from here to here. it went up going 4%. So we missed out on the last 5%, and then it started on its way back down. Now it's just a temporary thing. Well, I don't know, but this bullish engulfing candle for the weekly is very vicious. We had a couple weeks ago where it started down and then made its way back up, and now we're back to where we started from. And what everybody's talking about right now is this 4,200 mark on the S&P. That if we break this 4,200, there's going to be all types of algorithmic buying or selling of stocks. And I heard somebody basically say today, 417.50, and then it really, or 41.75, then things will really start to collapse as far as the markets go. So we're back to the trouble area we were a couple weeks ago, where we came close before we had a kick back higher. What's going to happen this time? We'll have to see. Now, sometimes there's retest of these things, and then they make their way back up, but it's not going to happen unless this 10-year starts to roll over some. And there's some things that could make that happen next week, especially the PCE, but that's not reported till next Friday. I don't think it's, IWM, the Qs, this box that we had, we've now broken out of the box. Now it's broken out of it before, at the beginning of this box. We could probably extend this box down, to around here to 162.29, but, you're still, within that range. So it could continue to come to 162.29, maybe start back to the top of this box, this range, and we can hope. So Qs got smashed. These again are weekly data. We had this uptrend for a long time, and then boom, this week just nothing good. Pretty much other than Monday, there was nothing there that would stop the momentum down. And if it gets below, what is that, 351.36, then there's some room to go down. Lots of gaps to fill here in different spots on the way down. So there, it could fall quite a ways. But it was just a brutal week. Been a good week to be in puts. The VIX is up, not as much as I thought it would be, but 30 cents. But we're definitely a more volatile situation. And then the breath has just gone away, and that's reflected here in the Russell 2000. So that's a look at the markets. Let's take a look at the economic calendar. And we started this week on the 16th. The New York manufacturing came out weak. Not as weak as expected, but still weak, and certainly a lot less than the previous period. And the markets were pretty calm on Monday. Went up a little bit, and then on Tuesday, retail sales came in stronger than expected, and this began the climb of the 10-year. Pretty much all the reporting that was done during this time period. Look, the mortgage rates went up to 7.7%. You're probably going to be looking at 7.75%, maybe 8% next week, maybe more. If it continues on this trend before it reports on Wednesday. Building permits came in stronger. Housing starts came in not as strong. We even had on Wednesday, it was on Thursday, we had Powell speak on Thursday, and he said, no, we see that the increases have done their job, and because rates, the 10-year yield's going up, and so he doesn't really have to do anything at this point. So I don't expect them to raise for quite a while. I haven't looked at. We'll look at that next week as far as the estimates go. Initial jobless claims came in lighter, and all these things just kind of kept gathering. Every time one of these things was reported, it seems like the 10-year yield, you would jump up another 5 points or so. So that is a look at what happened this week. And we started into, well, the only thing I probably should mention is existing home sales came in a little bit stronger than the consensus was, but that was about it. So looking at next week, really nothing really to report until Tuesday, where we get these S&P PMI reports. Expectation, again, contraction under 50 for both services and manufacturing. There's a composite. You start to see, you can see the forecast 49.8. So that should be things contracting. Our expectation is that the mortgage rates will continue to increase. New home sales, you would expect to fall. Forecast versus consensus, I need to understand more about what the difference of those two are. Then we have the Powell give another speech next Wednesday, but it's after market hours. I doubt he'll say much unless the rates continue to go up. Then he may be saying something. So, durable goods orders are expected to come in at 1.5%, which is pretty strong, because we had 0.2% last time. And so they're expecting continued growth out of this. And additional jobless claims will get reported. What else do we have here? Pending home sales. And then the big one will be PCE, unless Powell says something dramatic here, like we're going to cut rates or something, but I don't think he'll say that. He certainly won't get on Congress for all the spending, but the good news, we don't have a speaker right now, so they can't spend as much. Somebody on Twitter basically said, oh, we got to get him there. We got to fund all these laws we passed or all these things we passed. Well, I'd prefer they not be in many cases. So that really is it. The thing I wanted to talk about in my final comments, before I do that, let me just kind of look at this Truflation, because it is started to go back down with these crushing rates. You can see food and beverage is down 0.2% since last week. Housing down 1.22% since last week. Transport down 0.5%. So, these things are all trending in the right direction, but the 10-year's kind of got a mind of it. 10-year yield has a mind of its own right now. So my final comments are basically kind of getting people thinking in terms of the upcoming recession, and what things don't do well in a recession. Well, it's going to be things like retail. It's going to be things like restaurants. It's going to be things like travel and leisure. Real estate will continue not to do well. Manufacturing. So pretty much everything is affected, but some of the ones I mentioned at the beginning, especially retail, restaurants, travel and leisure, those tend to get hit hard in a recession. So I'll probably start to put a few more things in there about expectations, especially in these areas. Now I've talked about them in the economic calendar, but whether we wind up getting deflation or it just goes straight to inflation, it's looking right now at the moment, and things can change. And as crazy as the last few months have been, I can't expect anything, but it's looking like, Peter Schiff is, he's saying the dollar should go down. We've not really seen a lot of that happen. As far as the DXY, let's just go back there real quick. DXY, yeah, it's just kind of going sideways right now. You know, expectation both Peter Schiff and David Hunter is that, you know, the dollar, both of them expect the dollar to go down. The 10-year yield, Peter Schiff is basically saying it'll continue up. David Hunter says no, it's going to roll over. I don't see any signs of that yet. So it seems to be favoring Peter Schiff right now because he thinks that thing could, you know, the 10-year yield can continue on up, you know, for a while, and that will crush the markets, which seems to be where we're headed right now. But you know, things can change. You know, a number of things can change. You know, if Powell came out and said something different, or there was some turnaround, or you know, I think a lot of this to me is being driven, well, by a number of things, but certainly the wars in Ukraine, which people got used to, and the war now that we're looking at with Israel and Hamas and whoever else is going to participate for the Arabs, can really drive a lot of the negative sentiment too. You know, what's going to happen, and you know, that all this uncertainty, and it certainly for a while, the last few days, you know, all of that uncertainty has driven the gold price up. It came back to earth a little bit today. It got close to, not on the futures, but just the spot price came close to crossing 2,000 today, and that before it backed off. So we'll monitor these things and see, you know, what happens. I think, you know, next week is going to be very telling. We break 420, you know, 4,200 on the S&P. You know, I think that can really start a really hard downtrend for all of the markets. So I'm watching it closely, and we're close to it right now. You know, we're at 42.24. We were down 53 today. We have another 53 down day, like we did today, and you're well below it. So we'll have to see what happens, if there's some resistance there or something that can drive it back forward. Anyway, that's what I wanted to cover this week. And remember, there is always a better way.